All right, my friends, so the yield curve has inverted, and I find it ironic that the yield curve inverting now is the 10 years, the yield on the 10-year as opposed to 30-year. 30-year is still at 2.88. A 10 year is now at 2.44, and I think it was the 1 year is at 2.45. I think the 1 month T-bill is like 2.43 or 4 or something like that. All right, so we have 1 basis point inverted yield curve, and everyone's flipping out. You should see, it's almost like the financial media. They love the negativity. I mean, look, I get they don't like Trump. I get it. I'm for sure. They like when the carnage is in the street. They get more clicks for that. That's all there is to it. Is it concerning? No. It's a recession. Like I said, they happen all the time. The Dow falls 420 points today. Look, man. I mean, given where the Dow is, what, 26,000 or something like that? It's more than average, but it's not unique. In fact, I was reading, I think it was Jeremy Siegel. He said where the Dow is now, the average day should be trading about a 175 or something like that. So it should be 175 points on any average day. I don't know. I look at all this stuff. It's just financial pornography. There's no other way around that, and it's frustrating. But it's been like this forever. There are always negative Nellies out there. They know what leads clicks is chaos and carnage. It leads clicks. We know this. I was just looking at my Apple lead on the news thing on the Apple stock market index. All negative stuff. I mean, they got a picture of the lady from Blair Witch Project. Oh, they got a picture of a Wall Street Journal going, oh, whatever. Oh. I'm like, jeez Louise. You'd think they just saw zombies coming to get them or something. It's nuts, man. I mean, okay, could there be a recession? It's like economists. They predicted 17 of the last 4 recessions. Does the inverted yield curve predict every single recession? No, I did a video on that that showed you it didn't. It showed you we had a yield curve. At some point later, we had a recession. Did you know? Shh, don't tell anybody this. I will predict something for sure. Shh. If you eat carrots, you will die. If you eat carrots, you will die. So again, if you eat carrots, right? Let's say you ate carrots today. You know you're going to die. I just proved my ability to predict things, right? Because at some point you will die, and at some point I predicted you will die, and at some point you ate carrots. Oh my goodness. Correlation leads to causation there, huh? The same thing going on here. I mean, I just showed you a couple months ago, maybe a couple weeks ago, I showed you a chart. They said the inverted yield curve. So inverse. Here's a recession. Okay, well, sometimes the recessions are the next day, sometimes they're the next 3 years. Come on, man. We got a recession every 5.5 years in this country. So if you have an inverted yield curve today, and the recession happens 2 years from now, do we attribute that to the inverted yield curve? Well, that's what they're implying here. Jeez Louise. Just drives me crazy. Recessions happen all the time. Should you do anything? No. I mean, my goodness, you have a good investment strategy, the barbell approach, the cash. The way the inverted yield curve, if you ask me, means that the bonds don't do anything for you whatsoever. You definitely need to have cash on the side now, just because you want to be able to, when the yields go back to normal, potentially you want to be able to lock in some higher rate CDs. But you're not getting any reward for the risk you're taking by locking up your money in any bonds whatsoever. So 2-year, 3-year ladder CDs, fine, but you don't want anything more than a couple years because it doesn't give you any good. There's no benefit there whatsoever. If you're going to take the risk, you might as well just be in stocks. All right, I mean that's just all there is to it. So you got the barbell. You got stocks on the far end over here. You got nothing in between. You got CDs and cash on this side. It's just literally that simple. And that way you don't have to worry about a recession. You don't have to worry about an inverted yield curve. You don't have to worry about doom and gloom that these prognosticators are predicting. All right, and I was reading one today. There could be a 40% chance of market fall. Man, there's always could be a 40% chance of market fall. Always. The point is we want to make sure you got enough cash to handle your income you need when you retire for 2 to 3 years. That's what we want. If you're working, that's your bond. Your income's your bond. We want to make sure there is enough cash so you don't have to sell stocks if they're down 40%. We want to make sure. That's what we got to avoid. Don't sell stocks when they're down 40%. Will stocks drop 40%? I don't know. They have routinely. 1973, 1974, 2001 and 2, and then again in 2007 and 2009. So in my life, we've seen 3 instances of that happen, and that's just year over year. I hear a a woodpecker chomping into a tree there. Do you know the reason a woodpecker chomps into a tree is because that tree's dying and he's getting the sap that's in there? I learned that from Howard Garrett at the dirtdoctor.com. So if you have a woodpecker, you hear there's a dead tree over there, and that's not good. So we might have to take that sucker down. All right, so don't worry about the inverted yield curve. Hang in there, you'll be fine. And at the end of the day, what are you gonna do anyway? Put it all in cash? I mean, that's just don't do that, because at the end of the day, cash after inflation, taxes, is a net loss. It is. Now people say, but at least I'm avoiding a 40% decline. Yeah, I get it. I get it. You are. But when are you going to get back in? And if the answer is never, that's fine. I mean, if that's what makes you sleep at well at night, I don't care. I'm not going to here to bang the drum for stocks. I just think at the end of the day, stocks do it right. Cash does it right. Combination thereof does it right. In the long term, a stock portfolio will perform better than an all cash portfolio for sure. I mean, look, we don't know. Anything could happen. We could get nuked tomorrow and all bets are off. But right now, just remember, if you eat carrots, you will die. Careful about those carrots. We'll see you next time.